Life Matters, a Penn Mutual podcast for financial professionals, bringing you life insurance insights from advanced sales experts and life insurance specialists. Grow a stronger practice today.
Welcome to another episode of Life Matters, a Penn Mutual podcast. I'm your host, Bill Bell, Vice President of Advanced Sales with Penn Mutual, and I am so pleased that you chose to join us here today. Now, we wanted to do a product-focused episode of Life Matters, a Penn Mutual podcast, early on in our series of episodes. So I asked a friend of mine, somebody that I've known for a long period of time, Bobby Samuelson, the president, publisher, editor, king, whatever you want to call it, of Life Product Review, to join us here today to talk about what he's seeing in the industry, what has him really excited from an industry standpoint, a little bit about private equity entering the life insurance industry, and then a little bit about Penn Mutual at the end here. It was a great conversation. So without further ado, let's just get to that discussion I had with Bobby, and then I'll be back on to wrap it up after the discussion is over. All right. Well, Bobby, thank you so much for joining us for this episode of Life Matters, a Penn Mutual podcast. It's really a thrill to have you here today.
Thanks for having me. I appreciate it. Always a pleasure talking to you.
So Bobby and I have known each other for a little over 15 years, and you might not remember this, but the first time we met, the world was literally collapsing, or at least the financial world, back in 2008. Can you give everybody just a snapshot of, I mean, you were a really young guy in the industry at that point there, in regards to kind of what you were thinking back then in regards to, hey, did I really make the right decision to get into financial services back in 2008?
So, I think actually being from Charlotte, and Charlotte is Banktown, USA, so it's the second largest banking center in the country, and hearing the horror stories from my friends that worked at Wells Fargo, or actually at the time, Wachovia. So they went to go work at Wachovia, which was, basically had bought a mortgage broker out in California, I think Golden West, and it basically took the company down. And then I had Bank of America is also headquartered in Charlotte. And so frankly, insurance felt like a little bit of a safe haven in 2008 because the rest of the world was actually, was going nuts. And so I felt like it was actually a pretty good call. It was interesting at the time I worked for NFP, and I think our stock price got down to like 70 cents or something crazy like that. And it had been at $14 or $15. And I do remember everybody kind of going, I don't think we're that bad. I don't think we're actually in that bad of shape. Like, our business is good. Production is actually okay. We're not a financial intermediary, and so we don't have this asset price pressure. And so it did seem a little bit like at the moment that the world was falling down, but also that we were going to be okay. And frankly, that the companies that we worked with were also going to be okay. And that actually is what happened. So in some ways, I felt like it was actually the perfect sort of introduction a little bit to why insurance is different, because, being from Charlotte and hearing the horror stories from all my banker friends, and then sort of looking at the life insurance world and thinking, okay, outside of a couple of kind of small examples, one big example, AIG, which obviously has some issues, but a lot of that came from their financial products division. Almost all of it came from their financial products division. And then looking at all the mutual companies we worked with, even a lot of the stock companies we worked with, and thinking, yeah, in the grand scheme of things, these companies are actually doing really well and came out of that sort of stronger than ever. To me, it was a little bit more of a validation that I made the right choice, and that this was the product category and the industry that I wanted to be in, because the worst possible thing in the financial world that could have happened did happen, and yet we came out of it stronger than ever. So yeah, it was definitely an interesting time, but I'm thankful for it. I graduated college 2007. To your point, rolled right into the crisis of 2008, and I'm thankful that was the first few years of my career. It definitely made me more paranoid and a little bit more conservative than I might otherwise have been. But I think it was just a great example of where insurance actually showed really well.
But I think you're right. I think that it really kind of proved how strong we are as an industry, that for the most part, most of the major carriers came out very much unscathed. A little bit of a downside financially for a couple of years there, but definitely from a liquidity standpoint, remained very strong. And I wanted to bring that up because we had a similar type of situation last year with some other small regional banks. And you wrote a great article kind of comparing the insurance industry with regional banks like Silicon Valley Bank in regards to why the insurance industry is different and why you don't think that you're going to see kind of a similar run on the bank. obviously I don't want to be taking away kind of your secret sauce in regards to your newsletter, but maybe if you could kind of give a little overview of what you said in that article and how it was relevant for readers at the time and still today.
Yeah, that's a really fun article to write. I mean, I write an article every week, and some weeks it's harder than others, and that one was just an absolute slam dunk. I had all the data. There was so much sort of noise in the world around SVB. And the question that I went to with that article was, can we run a similar analysis on life insurance companies? And so I started to see all these graphs. I'm a Bloomberg subscriber. And so I started to see a lot of graphs in Bloomberg saying, basically if you look at all the top banks and kind of where their holdings are on a mark-to-market basis versus their capital, what does that look like? And what it showed was that a lot of banks were, technically flirting with solvency, or there were a few banks that were like SVB that were effectively insolvent. And then a lot of them had obviously much reduced capital ratios once you took all these capital losses into account, that they may or may not have to mark to the bank accounting is kind of quirky, but they may or may not be marking them to their books. And so the question is, okay, well, who else owns a lot of long bonds and has a capital pool? Well, obviously life insurance companies. And so what happens if you run life insurance companies through the same analysis? And what was really interesting in doing the analysis, and I never know when I do work like that, what the result is going to be. So I went through, and there's a very particular part of the statutory statement that shows fair market value versus book value. And so for those who are not familiar, life insurance companies hold bonds at book value, but they have to report fair market value in the notes. So I literally went through, it took me a couple of days to go through, 40 plus insurance companies, pull their statutory filings. A lot of them I already had, but I had to pull some more. And then look through all the fair market valuations and try to figure out, okay, what's the actual, if you were to mark all these bonds to market, what would the actual capital position for these companies look like? And what was fascinating was most insurance companies, 60% or so, would be insolvent by the same kind of ratio you use for banks. So if you compare capital to losses on these bonds, most companies were upside down. But the point that I made that I think is the really important point is that banks are in the business of liquidity. So if you're a depositor at a bank, you demand liquidity. And so these bonds actually could be liquidated at a bank. And that's the reason why they have to mark them the way they mark them. If you've got a lot of depositors and they ask for their money all at once, which is what happened at SVB, you have to liquidate those bonds, you take the loss, and you've got a real problem. And my point for insurance companies is twofold. Number one, insurance companies have real benefits beyond just liquidity. So when you buy a life insurance policy and you've got a lot of cash value in there, let's say it's a mature whole life policy or a mature IUL policy, you do have immediate liquidity, almost immediate liquidity. We'll come back to that in a second. But you also have a death benefit, and you also have deferred taxes, and you have all these reasons to keep this policy and to not actually liquidate the contract. And so there's a natural, our liquidity issues are not nearly as immediate as you find in a bank. That's one thing. Second thing is, and I think SVB is a really good example of this, but they had some big corporate depositors that sort of all made the same decision to leave all at once. Well, we don't have that same situation in life insurance. We have Coley and Boley, which is probably the closest analogy to this, but no company has so much Coley and Boley that it makes up 40, 50, 60% of the block, which is what SVB had with certain large depositors. So we have a lot of individuals. Those individuals would all have to make that same decision at the same time. They don't. And so again, they don't ask for the liquidity. And the other thing is, talk to normal people. They own life insurance. They don't really understand how the liquidity works. Like, they understand that they have cash value, but they don't see it on an app on their phone in the same way that they do their bank accounts. And so you don't get the same sort of run on the bank mentality that goes on. And so long story short, you just don't see the same liquidity pressures. So even though we have an asset problem, we didn't have a liquidity problem. And that's why we didn't have SVB type situations going on in the life insurance world. The other thing that I think kind of goes underappreciated is that if there ever was a run on a bank at a life insurance company, every life insurance company, every contract has a 6-month payback provision. And so let's imagine that every policyholder of XYZ insurance company asks for their money all at once. The carrier could basically hold off for 6 months to pay anyone. And that gives you a lot of time to unwind the assets and to kind of select how you're going to do that from a liquidity standpoint, which in a lot of ways completely kind of stops the run in its tracks. And you would have people who effectively would not end up asking for their money because it takes 6 months to get paid back. So I think there's a lot of kind of dynamics of this that make our industry more resilient, not because we don't have the same issue as banks. And by the way, that issue persists. So a lot of banks still have long duration bonds on their balance sheet that they bought in 2021 that have reduced in value. Same thing goes for insurance companies, but we don't have the same liquidity pressure that the banks do. And that's also why we haven't seen, so banks that aren't as concentrated in certain industries, don't have as many corporate depositors, have actually done okay because the same liquidity effects are going on there. People aren't actually asking for the money. And the same is true for life insurance. I track surrenders on life insurance and annuity blocks across the industry. We have definitely seen an uptick on annuities, but at the same time, what's happening is that money's recirculating through to some degree. On life insurance policies, surrenders have barely ticked up, even as rates have gone up dramatically, which means people are not going in and trying to get the money out of their whole life contracts. You just don't see that same liquidity aspect. One last thing on this that I think is important in that same mentality, though, that I wrote an article on this last week, is that the long duration bond problem is a problem in terms of fair market value, because if you bought a long bond in 2021, rates go up, obviously the value of the bond goes down. That's what we've been talking about. But the other thing is, and banks and insurance companies feel this, you still have the asset on your balance sheet. It's still earning a pretty low yield. And so there are a lot of insurance companies out there. There's one in particular that has like 96% of its assets invested in 10-year plus duration paper, which means that as interest rates go up, those policyholders are not going to get increasing caps, or not going to get increasing crediting rates, because that company owns the vast majority of their bonds that are long duration. Those things aren't rolling over for years and years and years and years. And so there is a little bit of an interesting dynamic of, even if people don't take the money, the carriers still have low yielding assets laying around. And there's a long tail to that could mean that caps and par rates and crediting rates and dividend rates don't go up as fast as you think they would, because carriers have 20-year bonds laying around that they bought in 2021. So that's really, I think, the big effect that we're going to be talking about for the next 10 or 15 years is not so much, hey, we have an SVB scenario where where clients take liquidity and bust an insurance company. I don't think that's going to happen. Instead, it's going to be, gosh, this lag as interest rates go up was a lot longer and a lot deeper than we thought it was going to be. And I think that's going to be the most kind of permanent change that people talk about.
So really interesting analysis, really interesting dynamics. Obviously, great to hear in regards to kind of the liquidity issues in life insurance carriers. We started off with some meat right up front here, but we skipped over the fluff, which you usually have at the beginning of the podcast. So maybe you could give everybody a little bit of an idea about who you are and what you do and what your company does, because I think that's important to set up here relatively early in the podcast.
Hey, look, I'm a straight to business kind of guy. So whenever I go up and give a speech, people are like, "What do you want for your bio?" I'm like, "Nothing. Just let me go up and do my thing." So I kind of appreciate the meat side. Yeah, the quick fluff is I'm a product guy by trade. Started at NFP back in 2007, 2009. 2009 is how long I was there. Started a little consulting company, helping insurance companies, ended up helping a lot of insurance companies build their first IUL products. And then I started a newsletter along the way, worked with a lot of high-end producers, kind of did a bunch of things. 2013, went to go work for MetLife. I was traveling too much and I was, out on the road all the time. And my wife was like, you need to kind of figure that out, come home more. And so I ended up going to go work for MetLife. MetLife turned into Bright House. And in that transition, they let me run product development and pricing for life insurance and annuities. So I think a lot of people kind of think of me as a life insurance person, and I am. But a lot of my brain is also annuities. And so I left Bright House in 2017, and now I write the Life Product Review, which is a once a week. It's moving to once every couple of weeks now. It's pretty busy, but once a week, once every couple of weeks or so, 2,000 to 3,000 word deep dive on what's going on in the life insurance business. And then I also give a lot of speeches. I do a little bit of consulting work on that side with producers and with clients, sort of a pro bono type of stuff. And then my main job is actually doing product development. I run an independent product development company called Life Innovators. We've got 8 employees over there. And we actually help small and mid-sized insurance companies get into products that they've never done before. So think about, a Midwestern mutual company that's never done an annuity contract or a fixed indexed annuity. We're going to help them do that. Or a company that's never done an IUL, we're going to help them do that. Or a company that's never done a VUL, we help them do that. A couple of actuaries on staff, salespeople, project managers, product geeks like me, competitive intelligence people. And we literally do everything through the life cycle of product, everything from coming up with a concept to filing it, pricing it, putting it in the admin systems, writing the marketing material for it, all behind the scenes. You'd never even know we were involved. But that's the main business that we do. So they all kind of work together. The stuff I learned doing product development sort of feeds what I'm writing about, feeds what I'm speaking about. And that's who we are and what we do.
Well, I want to circle back to something you said there in regards to your time at MetLife. So obviously MetLife, huge insurance company, biggest in the industry, I think at the time, at least just and life insurance was just a piece of what they did. What lessons did you take away from your time there at MetLife? And does it help to shape your view of the insurance industry?
Oh my gosh, Bill, what a question. Um, it's funny. So I got there in 2013, and MetLife I got there in December of 2013. We had gotten out of guaranteed UL in like July of 2013. And so we had been a top three seller of life insurance, and then we basically completely fell off the map. And I learned a lot in that process. I learned that brand name only gets you so far. I mean, MetLife had arguably the best brand in the independent business. Great ratings, great brand.
They had
It's very
Snoopy.
hard to make. Snoopy.
Yeah.
Yeah, Snoopy. And Snoopy counted for a lot, actually, not, interestingly enough, internationally, but also here in the US, there was a real brand presence for it. It's really hard to make the pivot to non-guaranteed products. We had a career force that was really helpful in that. So I also found that independent brokerage tends to be kind of fickle, but the career force relationships really matter there. And I think Penn Mutual actually does a good job of this by sort of saying, hey, we have a career force, but we also have a relatively limited number of key relationships at producer groups. And that works really well. Like I think there's something to that relationship, because when you try to make the pivot in a more independent environment, it's really hard to do that, even if you have a great brand name, even if you have ratings. But the big thing, and you kind of alluded to this, is just that, life insurance as a product category doesn't get the attention that it should at most big insurance companies. And, I can't speak for other insurers because I haven't worked there, but at MetLife, even though our legacy was individual life insurance in the US, that's what created MetLife. We were a rounding error in the overall MetLife enterprise. And one of the things I've really come to appreciate, well, and you would think that the bigger enterprise would be helpful to the life insurance business, but it wasn't. And I think a lot of people say, oh, scale matters a lot in life insurance. I'm not so sure that that's the case. I think commitment matters more in life insurance. And so the longer I stay in this, the more I appreciate the fact that a small to a mid-sized insurance company actually can be really impactful in life insurance, because life insurance just doesn't get the focus at the bigger companies, and then people aren't looking to get into the space. And again, we do a lot of work in the annuity world. New annuity companies are getting into our business all the time. I mean, there are new annuity players popping up left and right, and a lot of them we work with. There are not new life writers popping up in our business. People are just kind of I don't want to say leaving it for dead, but they're just not committing to it, and you have to commit. And I think that was the issue at Met wasn't going to commit. And if you don't commit, you're not going to be successful. It doesn't matter your brand name, doesn't matter your ratings, doesn't matter what else is going on in the enterprise. So I'd say, yeah, I learned a ton. I think personally too, I learned a ton, just, how pricing works, how to think about all the various views of life insurance. And again, it goes back to this whole idea of commitment. If you look at life insurance as just a purely financial, capital intensive, transactional sort of thing where you put capital in and you get returns back, life insurance is a terrible deal. You have to think of it as a long-term growth strategy. And the analogy I would give you is, here in the South, you plant pine trees because they grow really fast, but they're actually pretty brittle. They're not very strong. Okay. Then we have oak trees. Oak trees take a long time to grow. And when they grow, man, they get huge, right? They get like this big around. They're super strong. They spread out their branches all over the place. And the presence of a great oak tree, you've never seen a pine tree that has the presence of a great oak tree. And I think a lot of times we come in with this kind of pine tree mentality, a lot of the new players in our space. Hey, we want to grow something quick. And I think a lot of companies have that mentality in their life business. Hey, I want to see a return quickly. We're not growing pine. In life insurance, you don't grow pine trees, you grow oaks. And you got to be committed. You got to stay in. And if you stay in long enough, you're going to build something really strong. But you have to stay in. And that's, I think, the reason. That's what I learned at MetLife is unless you're willing to do that, you really have no business in this space.
All that discussion of trees made me think of the Rush song Trees and Neil Peart's analogy of maple trees and oaks. Well done there. And put a pin in commitment, because we'll get back to that here in a minute when we start talking a little bit about Penn Mutual here. Yeah. But I do want to talk a little more about the industry as a whole before we get a little more specific. What are you seeing as far as innovations in life products these days that has you interested either on the good side or the bad side?
I think if you'd asked me that question 5 years ago, it would have been mostly bad side stuff. we got a real illustration war hangover. And I'll pay your employer a compliment here, which is that Penn Mutual was an offender in the illustration wars 11 years ago, 15 years ago. For the last 5 or 6 years ago, Penn Mutual's kind of stayed out of it. And so a lot of the ways that we see illustrations being gamed in IUL, Penn Mutual's kind of said, hey, we're not going to do that. And I really appreciate that because, again, 5 years ago, that would be the whole kind of dialogue. And I think a lot of that stuff is bad. Like, it's just not good for the industry. Whether those illustrations actually come to pass or not is a secondary question. If people are buying our products because they think the returns are going to be, because they didn't think they can take no risk and get all these high returns, that's a problem no matter what way you cut it. So I think I'm glad that that's not the conversation today. I think things have kind of leveled out a little bit on the IUL side. Are there still some problem spots? Yeah. But that kind of innovation, I think is I'm glad we're not talking about that. What I am really excited about, I'm really excited about two things. So one is VUL, and I'm a huge fan of VUL. I own VUL personally. I'm seeing the VUL category grow in some really exciting ways. And to me, VUL is just the easiest way to get a skeptic to be interested in life insurance, because we're not asking them to convert their crediting strategy or their assets into this crediting strategy they don't understand. We're not even asking them to buy general account assets. We're just saying, hey, take what you're doing outside and come over here and do it inside this tax advantage wrapper. You need the insurance anyway. So go on ahead and get the insurance and do more with it. And I think you can really make that argument in a VUL. So I'm excited about the fact that the category is growing. I'm also excited about the fact that the products are getting better. We're seeing more thoughtful VUL designs. We're seeing VUL designs with indexed accounts, with fixed accounts, with structured crediting strategies, with defined outcome funds. The world of crediting inside of VUL is just so much broader than it used to be. And to me, that's the right angle. If I'm 40 years old and I'm buying a VUL contract, sometimes I might like the indexed account, sometimes I might not. Sometimes I might like the fixed account, sometimes I might not. And VUL gives you the flexibility. So I'm super excited about that. And then I'm also excited about what's going on in the whole life space. So I own whole life as well. And I think following 7702 in 2021, we've seen just this incredible proliferation of lots of different types of whole life hit the market. And so I think carriers are being really thoughtful about how to build whole life for sort of a variety of different purposes. And as a result, broadening the market. Now, whole life's harder than ever to sell, because I think for a long time, people could just sell off the illustrated performance, and that doesn't really work the way that it used to. But as a financial tool, 2022 should have been the proof year for why you want to own whole life. Because when every other fixed income asset class got pummeled in 2022, whole life cash values only went up. And so to me, kind of making the case to a 45-year-old that the fixed income asset class they're going to want when they're 65 is whole life, that's an exciting opportunity to me. And carriers, I think, are building products that are more conducive to that story, more flexible. And so those are the two big things that I see that I'm excited about. There are some things happening in IUL that I think are kind of interesting. But again, the most innovation I see in IUL is putting indexed accounts in VUL and being really thoughtful about that. I think that's a great progression of the industry. So mostly VUL and whole life is on the life side is what I'm seeing that I'm excited about.
So I also own VUL. That's the only cash value product type that I own. And it's because I do love the flexibility and kind of my ability to really affect the performance within the contract and not be completely reliant on the insurance companies in regards to cap rates and so forth. Plus, I do have those indexed options and so forth. And so I agree. I love VUL, and I'm excited to see a renewed emphasis on it. When I started my career, I started in insurance a little earlier than you did. VUL was still king at that time, 2002, 2003. Yes, we just came through the dot-com bubble, and a lot of people had been burned with some 12% illustrated VUL contracts and so forth. But it was still the product choice for so many people at that time. And then it just seemed to go to the wayside for 20 years. I mean, literally 20 years. And now people are focused on it again. And it's really excited to see. Do you think that you're going to see people that have dropped their FINRA licenses in the past maybe start to get re-registered just so they can sell those products? Because that's really does seem to be where the innovation is these days.
Oh man, that's a tricky one. I hear this all the time. Like, I dropped my FINRA license yet. Getting one back is hard. They got to go take the test, and then they got to be under broker-dealer supervision. I think there's a certain subset of advisors who are just not going to mess around with it. So the question is, all right, well, who's going to sell all this VUL? And I think it's financial advisors at financial institutions is where the growth is. And I think the little caveat to that is that not all financial institutions are unaffiliated with insurance companies. So, for example, what is a Northwestern Mutual advisor? Well, on average, a Northwestern Mutual advisor derives half of their income from managing money and half of their income from selling insurance. I would say that financial advisor looks a lot more like a financial advisor at Merrill Lynch and Morgan Stanley than would have been the case 10 years ago. Northwestern Mutual is the third largest VUL seller in the country. Same thing for RiverSource. RiverSource is obviously owned by Ameriprise. They sell a large amount of VUL and a growing amount of VUL in that channel. So I think the idea of the independent producer, a lot of, frankly, the folks that Penn Mutual serves, I think the challenge is that they did drop their licenses. They're in their mid 60s. They're probably not going to go pick it back up. But it's this kind of next generation of advisor. It's the future of distribution. It's where some of the firms that Penn Mutual works with, those producer groups are picking up advisors that are coming out of other channels that still have their FINRA licenses. That to me is where the opportunity is. So it's not the 65-year-old. Frankly, it's the 45-year-old who's got a registration, who can sell variable products and is talking to people their age. VUL is the perfect natural fit. And I think that's where we're going to see that growth tick up. And again, you can just see these examples in the industry of where firms like Northwestern, firms like RiverSource have picked up a ton of sales. That's how they're doing it. It's not convincing the old school insurance guys to go back and look at VUL. It's finding a way to incorporate VUL as a part of holistic financial planning with more securities-based advisors, with more registered reps. And I think that's part of this angle on VUL. One other interesting thing, by the way, on VUL. So if you look at VUL sales across the industry, they're growing a lot. Some of the biggest growth drivers have actually been in the PP VUL space. And I think a lot of times people go, oh, that's PPLI, like totally different deal. That doesn't apply to what we're doing today. Oh, hold on. Why are people buying PPLI? Why are people doing PPVUL? Because they want to be able to tax control the asset. People who are worth 30, 50, $100 million definitely are thinking about taxes. So are people who are worth $2, $3, $4 million. So are people who are worth $2, $3, $400,000. Everyone thinks about this. And if you're using 529 plans, if you're using, like a SEP, if you own a business, you're already making tax preferences. Rather than letting your excess savings fall in your brokerage account, go put it in a VUL policy. And so I think the same logic that makes PPLI attractive actually works down market too. And so it's not just a high-end planning tool. This is anybody who has a brokerage account should also, if they own life insurance, which they already should say, well, gosh, if I own term insurance and I have a brokerage account, why not put those two things together in a VUL contract and get tax advantages that my brokerage account can't give me? Now, I don't have as much investment flexibility, and the reporting isn't as good, and I can't day trade my VUL product. But for long-term financial planning, there's a real nice fit here. And so I think that's where the opportunity is making that argument. And I think that's going to resonate the most with younger clients, younger advisors in a holistic financial planning context.
All right. One last industry related question. So we're about 4 days past the FinSecca Advanced Markets Conference, which you just spoke at, as did I.
Yep.
And you gave a really interesting presentation on private equity in the insurance industry. You probably didn't notice because I was in the back of the room, but I was there and I did listen and I took some notes. I thought it was an interesting presentation in as much as you really kind of explained what PE being in the industry means and where their focus really is. So for those that weren't there and weren't lucky enough to be in your session, because there was like 9 breakouts going on at the same time, even though you had by far the most people in yours, I will say that. Can you give a little 10,000 foot overview of what you talked about and what private equity coming into our industry really means?
Yeah, I mean, I'll give you just a 30-second, or it's not going to be 30 seconds, minute or two. I think what I said at the beginning is the best mental framework here. We use private equity as the term. That's not really what they're doing. This is really private credit. And this is really the sort of the credit arms. And I used Apollo as an example. Their credit arm is, 3 or 4 times the size of their equity arm. So I think a lot of people come in thinking, oh, private equity, they want to buy an insurance company and sort of strip it for assets and then sell it. No, what they want to do is manage more money. And so the way that they want to do that now is by having insurance companies that raise assets for them to manage. And that's what Apollo is doing with Athene. That's what KKR is doing with Global Atlantic. And so rather than raising money from traditional sources, endowments, family offices, pension funds, things like that, now they're just raising money from annuitants. And so really that's at the end of the day what they want. They want to manage more money. And I think for those of us on the life insurance side of the world, that's actually a positive sort of way of thinking about it because we tend to, I think a lot of people are very concerned about private equity coming in and sort of dismantling insurance companies. And again, that's just not what they want. What they want is more assets to manage. And that's also why they're not really interested in life insurance. Life insurance doesn't have a lot of assets. It has a lot of profit. If you have it for the long term, it has a lot of recurring premiums, but it doesn't have the same level of asset growth that you get in an annuity contract. So yeah, PE, right? These financial institutions, really, they want assets under management. They're going to do it through annuities. I think where life insurance comes in is as collateral damage. And so if you have, a company that gets bought by an institutional money manager, they don't care about life insurance. They care about annuities, which means they may actually not do very well by the life insurance policyholders, not because they are intentionally doing that, but because they just don't care. It's a line item. And so I think that's where the angst is appropriate. Is okay, if you have an institutional investor getting into our space, buying a company for the annuity business, what happens to the life business? And I'll go all the way back to 2010 when Apollo bought Aviva USA. And when they bought Aviva USA, there was an annuity arm, which was really big. And there was actually a life arm, which at the time was the number one IUL seller in the country. Anybody who works at Aviva will tell you that there was like a 2-week period where the Athene guys, the Apollo guys, were walking around the office. And then all of a sudden, what did Athene do? Boom, sold off that life business as fast as they could. And I think that's the mentality that these institutional investors have. They don't care about insurance. They just care about annuities. If life insurance gets in the way, they send it off. That's where you could be concerned. And again, it goes back to what we talked about earlier. It's commitment. These firms are not committed to this. And I'll tell you one quick funny story about this. I was on a plane. I will not say what company this was, but I was on a plane, 10 years ago. And I was sitting next to this guy going from San Diego to Phoenix. And so short flight. And so we were talking and kind of catching up and, what do you do? Blah, blah, blah. This guy works for a private equity firm that actually just bought an insurance company. I said, oh, that's interesting. You just bought, XYZ. What do you like? What's the plan? I know you guys kind of want the annuity stuff, but what are you guys doing on the life side? And he leaves there and he goes, I don't know. He goes, we don't care about the life side. He goes, we'll figure it out. So we're going to run a little experiment. We're going to put some capital behind it. And if in, 2 or 3 years, it doesn't work out, we'll just dump the business. And by the way, that is exactly what happened. And he was so cavalier, so nonchalant about it. And look, in the annuity world, those are 5 to 7 year, 10-year transactions, usually for accumulation annuities. Our products are 10, 15, 30, 40, 50-year commitments. And I think that mismatch is real. And I think that's where the concern should come in for those of us on the life side, is just making sure that if an institutional investor buys a company, again, they're not being malicious about it. They just don't care. They're in it for the assets, and the annuities deliver the assets. The life insurance is collateral damage.
So I guess my follow-up question there is, if a financial professional is listening to this podcast and they have clients that have policies that were written by companies that have been taken over or are going to be taken over at some point in the future by private equity or private credit firm, should they have concerns in regards to the future performance of the products that their clients own?
We've seen examples of where institutional investors have really treated policyholders well, where the ownership of an institutional investor has not materially changed the position of in-force policyholders. We are accruing more examples of where that's not the case. And so what I say in any of these transactions is wait and see. Don't jump to conclusions. Again, from my interactions with these people, they're not malicious. They're not out there to change your non-guaranteed elements. They really generally try to avoid getting sued. And they know now that changing non-guaranteed elements will get them sued. They generally try to just leave it alone. They're not going to support it. They're not going to go out of their way to make it better. But they generally just try to leave this business alone, except in a couple of examples where it does look like they are just kind of hitting the non-guaranteed elements and doing some things that are not totally fair. So I'd say, is it a reason for concern? No, but it's a reason to do an annual review. And it's a reason to make sure you keep an eye on non-guaranteed elements. And at some point you should ask, hey, are we getting fair treatment here? But don't do anything. don't jump ship immediately. Now, if you see any situation, and there is one going on right now, where concurrent with the acquisition, they materially change the deal for policyholders, get out. That is completely acceptable to get out. But most private equity firms or institutional investors that buy these life insurance companies just leave the life block alone. They don't mess with it. But if you see them messing with it concurrent with the transaction, and again, there's one example of that happening right now, then you have every reason to believe that that's going to continue to happen in the future. Go.
All right. That is great advice. So I want to end with some discussion about the company that I work for, Penn Mutual. and this idea of commitment, because you've brought that up a number of times during our conversation here today. Obviously, we are a committed life insurance carrier, and it's something that we really wear as a badge of pride. Our CEO, Dave O'Malley, was on this very podcast a few months ago and talked about that. What do you think about when you think of Penn Mutual as a carrier, and why should financial professionals be excited to work with Penn Mutual?
Yeah, well, I can't give a commercial for you, but I will say this. I think the commitment aspect, like I said, counts for a lot. And I've been impressed kind of looking at Penn Mutual's trajectory over time, that it seems to me that Penn Mutual is not just committed to being in the business, but in being in all parts of the business. And so I'll pick on ACE, for example. ACE is an underwriting program that makes it really easy to write Penn Mutual policies, that is innovative, that is a little bit riskier. Maybe you can make that argument. But it's, to me, that's a level that like you guys have a deep understanding of who your producers are and what they want, and you gave them something they really wanted. That's commitment. I'd say the same thing with your portfolio. Like Penn Mutual's portfolio is much broader than I think a lot of other companies. You kind of cross into every product line. To me, that's commitment into the business. It's also not being distracted. You guys have not grown a huge annuity business on the side. There's a certain finite amount of capital to go around at Penn Mutual, and it's not infinite. And as a mutual company, it's hard to go raise capital. And so from my vantage point as an outsider watching Penn Mutual, there are a lot of other ways to deploy capital that you could probably get a quicker and maybe even a higher return than writing whole life, for example, which is a notoriously capital intensive, long payback period product. And yet Penn Mutual has chosen to write that business. And so, to me, again, that just goes back to this concept of commitment. And I think that's just rare in our business these days. I mean, obviously there are some companies like the big four mutuals that are totally committed to life insurance, but even they have started to write a bunch of annuities. Even they are making capital allocations, not all of them, into things that are kind of outside the sphere of life insurance. And Penn Mutual does seem really focused on it. And I think that's playing well to Penn Mutual's advantage. I think it creates a lot of advisor loyalty. I think it's a good in today's market where it feels like in so many ways from an advisor standpoint that you're not getting mind share at the insurance companies. It's a very savvy strategy. I really think it's a good one. And I don't think it's different than what Penn Mutual's been doing over the last 10 years or so. You guys have been gradually building into that and kind of proving to people that you're committed to the market. And like I said, I think that's a great strategy for the life space. So I think it's commendable. As a product guy, I'd say I like the product offerings too. I think Penn Mutual's got a great suite of products, and it's continuing to kind of evolve and improve the product lineup. And that's a great thing for advisors. If you're an advisor and you want to commit to a company that's committed to you, you want to make sure you've got a full suite of product, and that's what you guys offer. One thing I will also say about Penn Mutual is that your conversion on your term insurance, you have a non-convertible and a convertible, but the fact that you have a convertible version is also a differentiator. Increasingly, I find people are like, oh, I don't need to commit. I can just write term insurance wherever. No, because the most valuable feature of a term policy is the conversion feature, not even the death benefit protection. And so if you're going to write term insurance, write it with a conversion feature and write it with a company that's committed to the business. And to me, that's a great argument for doing term with Penn Mutual. And I think that kind of goes underappreciated a little bit, that those two things come together on the term chassis.
Well, that was the most positive non-commercial I've ever heard in my life. So thank you. Thank you very much for that, Bobby. All right. I promised our marketing people we'd end with some fun questions here.
Because
we like to keep it lighthearted here on Life Matters, a Penn Mutual podcast. First one. What is the fastest you've ever gotten an email or a call from somebody where you analyzed a product or something that an insurance company was doing after you hit the publish button?
About half an hour. Actually, probably even less than that, Bill, now that I'm thinking about it. There was one, probably, let's go 20 minutes.
20 minutes. Do you ever hit the button and just go, okay, I'm going to turn my phone off and just go out for the rest of the day and I'll deal with all the blowback tomorrow?
Okay. So as you may not know this, but I give carriers 24 hours of heads up if I'm going to write about them. And so typically I already know what's coming and I've already had them look at it and make sure that at least my facts are correct, even if they don't like the conclusion. So the 20-minute response category, when I go, oh boy, we'll see what happens, is when it's a company I don't have a relationship with. Actually, I'll give you an example. The one I'm doing this week is a company that I'm not going to check with them because this is all public record. This is statutory filing stuff, and they're not going to be happy. And this is one where I do kind of feel like I could get some blowback. But at the end of the day, that's my job. That's what I got to do. And so it's a part of the business.
I can't wait to read that one.
It'll be a good one.
It's gonna be good. All right. We're big fans of barbecue here on Life Matters, a Penn Mutual podcast. You live in North Carolina, obviously, known for having top-notch barbecue in your area. Yep. Can you give us the sales pitch for why Carolina barbecue is the best? Or maybe you don't even believe that.
I am the worst for the sales pitch. So I grew up going to Lexington barbecue, which is the classic, vinegar-based sauce that's right up the road from here. I like mustard sauce, which is South Carolina style, so upstate South Carolina. I love that. And I lived in Texas for 4 years, and I fell in love with brisket. So I actually don't like North Carolina barbecue. I prefer South Carolina style. I'll even do a little Alabama white sauce every now and then, which I love. And I like brisket, like rubbed dry brisket from Texas. That's my trifecta.
Yeah, so I also love Texas style barbecue, specifically Central Texas. I mean, you lived in the Austin area, which is kind of the home of brisket there. So do you have a particular spot in Austin that you like to go to when you're there?
Yeah, well, I prefer the Salt Lick if I ever can make it out there. And then there used to be a place downtown. I'm blanking on the name of it that we used to go to all the time, Greens, I think. And that place was pretty good. All right, now let me ask you a question, though, because I think the sleeper of Central Texas barbecue is the turkey. Have you had any good turkey in Austin?
Absolutely. There's actually a place right downtown. It's a satellite location. The primary location is outside of downtown Austin, but there's a place downtown that is actually attached to the JW Marriott, which is where I usually stay when I'm in Austin, called Cooper's, which has terrific barbecue. It's right there on Congress. It's easy to find, really close to one of our primary distribution partners that you happen to know that's in downtown Austin there. So if you're ever there visiting, that would be a spot. They have great turkey there. Yeah.
Have you been to Lockhart?
Many times.
Okay. All right. Yeah. Okay. Then Bill, you're a barbecue pro, man. I'm just an amateur.
Yeah. Lockhart is, for those of you that are listening that haven't been, Lockhart is a city about 25 miles outside of downtown. Yep. Really known as kind of the capital of barbecue in Central Texas. They have three primary places: Smitty's, Black's, and Kreutz Market. They're all fantastic. You can go there and spend an entire day eating barbecue, and you would leave very, very happy.
You would leave very, very full. Yes.
Very, very full and very, very happy. Yeah. My suggestion would be, don't go into one and order the 3-item combo. Get a little sampling in the different spots. And
unless you like meat sweats.
All right, Bobby, let's finish for a little commercial for you. How can somebody subscribe to your newsletter and get more information about what you do on a day-to-day basis?
Yeah. So just go to lifeproductreview.com and you'll see we have 405 articles or so, something like that. We're actually putting an AI chatbot on there now, so you can search all the articles and it'll give you like a Bobby Samuelson answer. We trained it on just the articles. And so now it'll tell you, anyway, so that's kind of a cool feature. If you're just now signing up, you can check the backlog of all the articles, ask it questions, and it can kind of give you some responses on that. But yeah, it's $1,000 a year, $99 a month. That's kind of the standard deal. And if you're into annuities, we actually write a publication called The Annuity Edge, which is a separate but sister publication that covers what's going on in the annuity world every week. So that's how you find me.
All right, very good. Well, we've gone way over time. Our marketing people are going to remind me that we're supposed to try to keep these at 20 or 30 minutes, but so much great stuff to talk about in our industry. In fact, I'd like to reserve the opportunity to have you on for part 2 sometime, maybe here in 2025. But again, thank you so much for joining us here today. Really appreciated the conversation and looking forward to seeing you at some industry events later this year.
Thanks, Bill. Thanks for having me.
Well, that was just a terrific conversation. I always learned so much from Bobby. Just a wealth of knowledge on the industry and products. Just somebody that is always great to listen to. So thanks again, Bobby, for joining us here today. A few housekeeping items before we wrap up here today. I did want to mention that we, as of the date of publication of this particular podcast episode, we are 552 days away from some of the tax provisions of the Tax Cuts and Jobs Act of 2017. 552 days sounds like a lot, but it really isn't. So if you have clients that are in the position of being able to take advantage of those tax provisions, please make sure that they are doing so here, because 552 days are going to be here and gone before you know it here, and they might lose a real opportunity to maximize their planning. Also, since Bobby mentioned the Salt Lick and barbecue, I did want to preview an upcoming video series that we're going to have on the Penn Mutual YouTube channel called Bites, Sites, and Life Insurance Insights. It's a video series where I travel around the country talking to life insurance luminaries about life insurance related issues and some other fun stuff while we enjoy a sumptuous meal. In fact, barbecue might be involved in some or maybe even all of the episodes. We'll have to see here. But I can say that one of the upcoming episodes will involve the Salt Lake. So that was really unprompted from Bobby, and so I appreciate that. So keep an eye out for that. It is Bites, Sites, and Life Insurance Insights, and it will be coming to you soon on the Penn Mutual YouTube channel. Also, a couple of other things. If you have a question for me or for Bobby or anybody else associated with the show, feel free to drop me an email. The email address is lifematters@pennmutual.com. Again, that's lifematters@pennmutual.com. That's a special inbox that only I have access to. So if you have a question for me or Bobby or anybody else associated with the show, go ahead and send it to that email address. I do respond to every email that is sent there. Also, if you haven't done so, please subscribe to the show on Apple Podcasts or Spotify or whatever your favorite podcasting app is. That way you make sure you don't miss any future episodes of the show. And then last thing, if you are a subscriber on Apple Podcasts, please stop by and leave us a review. It only takes a few seconds. 5-star reviews help to boost visibility of the show. And if you have a couple more seconds, if you could drop an actual review in the comment section of the show page on Apple Podcasts, I would really appreciate it. We love hearing from our fans. So with that, for Bobby Samuelson, I'm Bill Bell. Thank you so much for joining us here today, and I look forward to speaking to you again soon.
Thank you for watching. If you enjoyed this video, don't forget to hit that subscribe button and turn on notifications so you never miss an update.